Hey everyone, welcome to the DPI Pod, where we talk to the top GPs to deconstruct pre-seed investing. I'm Vignesh, a partner at Sierra Ventures, and your co-host.
This is Brendan, principal at Sierra, your other co-host. Sierra is an early stage fund focused on enterprise B2B and frontier AI. Today we're excited to announce Nic Poulos, general partner at Euclid Ventures. Excited to get him on the pod. When we thought of pre-seed investing, who are the people that are living and breathing it every day and have done so for a while. So looking forward to digging in on your fund strategy and your journey, Nic, and how you see the market shaping up today. So welcome, Nic. Thanks for joining.
Thanks for having me, guys. Excited to be on the DPI pod and to chop it up with you guys today.
Cool. Well, let's start from the top. So let's talk about the origin story, Nic. You co-founded Bowery Capital back in the day, one of the top pre-seed funds, and it's been an exciting 10 plus years since. So why don't you tell me a little bit about your story, how you, inception story about Euclid?
Yeah, absolutely. It's hard to believe almost 15 years I've been in the venture world. Didn't start out the career with that intention. So actually started in banking and then did some operational roles, some startup stuff. But, found myself at actually AOL Ventures was the first exposure to venture investing. And that was back, 2010-ish in New York. The venture scene, as you guys know, was pretty nascent back then. It's like 5 or 10 funds, just kind of everyone all in on party rounds, and pretty unique time. But long story short, AOL Ventures became one of the more active, at the time it was called seed. Today it would be called pre-seed, that like first $500K, $1 million, right? Had some success and, rolled that into Bowery Capital, as you mentioned. So, some of our listeners here may be familiar with Bowery, know and love my colleagues that are still running it today. But yeah, I was there for 7 or 8 years, focused on first check investing in B2B SaaS. And, I kind of came to develop my love for focus on vertical software there. I also, that's kind of my early days at Bowery. Actually, AOL Ventures is what brought me together with Omar back over 10 years ago. So very, very formative time.
Hey, Nic, maybe one place to start, just talk about vertical AI as a category. Obviously, it's blown up a lot in the last couple of years. I guess when you were starting Euclid, it wasn't really a big thing, but it's kind of evolved into a pretty big thing. But love to hear kind of as you've seen this evolution, like why now for vertical AI? Why is this the moment?
Yeah, I mean, I think in a lot of ways, we see vertical AI as an evolution of a theme that we've been investing in for a decade plus, right? 5-10 years ago, we would have all called it vertical SaaS or even vertical software. So outside the name, what's different? Well, obviously it's the AI piece. And, I think what this kind of call it post LLM or LLM era has enabled is a couple of things. One, a range of new wedge products that just were not possible before, right? These are mostly, kind of NLP oriented. So it could be voice AI, it could be document generation, it could just be, NLP chat. But a lot of these product form factors just weren't feasible before. And I think that, it's given founders new ways to get into markets where, maybe SaaS had hit a wall or saw a lot more friction, a faster way to get uptake in certain categories. I think also there are just broad-based benefits even outside of vertical, right? I mean, code is cheaper these days, right? These businesses are much more capital efficient. You have to hire engineers probably not as quickly as you did before. So the net is you can get in a little bit easier and you can grow faster if everything's going well. And, we think while there's a lot architecturally that's shared with how to win in vertical AI and vertical SaaS, the opportunity set is greater. And so that's why Omar and I launched Euclid, and that's what we're focused on today.
Cool. Thanks, Nick. Next question is, so makes a ton of sense with vertical AI. Let's talk about stage. So pre-seed is different than seed or A. A lot of times, like we'll do some inception stage stuff ourselves. We've been doing a lot more of it lately, but it's completely different. Like there's not a lot of data to look at. It's kind of a bet on the person. Customer traction isn't always quite there. So how do you evaluate an investment? What gets you off a call when you're talking to a founder and you're like, that's someone that I may want to back, or this is a market that lines up with some of the things I'm looking for?
Look, that's obviously the name of the game at our stage, which, you could call it pre-seed. Honestly, we like inception stage the most because I think it speaks to what we like and a fundamental part of our strategy. At the end of the day, we feel that 100K ARR, 200K ARR, like while all traction is great, it's at the end of the day not that much different than zero, right? Like these businesses, if they work, can grow so quickly that often that's a matter of like a month of work maybe. So we would much rather underwrite what we think is the more important primitive, which is the team and the market, right? We can get into all the dynamics of the market. I mean, that's informed by us having invested in this space for 15 years, but we spend a ton of time, and the most time, as you could probably surmise, on the team. And, for us, we would back a team with less resolution around the idea and maybe even a new market we don't know as well if we fell in love with that team. There's a couple things for us that I think drive core interests, right? And I wouldn't say this is like a rubric where we're checking off a box, but like just to give you guys a sense for how we think about it, we are looking for founders that have some element of domain expertise that is going to give them an edge. Now, there's a lot of nuance around what we mean by domain expertise. That doesn't necessarily mean, hey, you've got to come from industry. Maybe that means you led go-to-market or product at a vertical software company, a vertical SaaS company prior, and your customers were in this category. Sometimes it even means like you're from a family that's been in this space for decades, and that gave you an edge, right? But these sort of founders, they have more higher likelihood of having real earned insight into a problem. They come with credibility, and like they come with kind of pilot partners seated in. So that by and large has been our focus. I could talk about founder qualities we like, but maybe I'll hand the mic back for a second.
Yeah, one follow-up question. So, and we're seeing this on the front lines. How is AI changing the founder profile? Because you've been at it for almost 15 years now. For us, like the last few years, a lot of younger founders are getting into the game. They're AI native. Is the Bay Area, is that the big gravity center right now? I know you've found alpha across the world, across the country. So how are you thinking about that? How has AI changed how you evaluate founders, if at all? Are you kind of riding your laurels from the last 15 years and think everything will kind of even out?
Never sitting on my laurels, Brendan. Never. Always pushing the boundaries. No, it's certainly changed the way we look at founders. It certainly hasn't changed that we feel that is by far the most important factor of any deal we do is the founding team. But I guess I would call out a few things. One, like exposure or mastery around the technical side of AI. I feel like that, I don't know, it's simultaneously more important, but also not the sole driver. Like I feel like there's this curve, if you were to map it out, where immediately in the first year after LMs were mainstream, where there was a bigger focus on technical capacity because the infrastructure wasn't there. There wasn't consensus around what tools to use. And so you kind of had to have someone who knew what they were doing. Now I think we're at a point where like there is some consensus there. So as long as there's just a great technologist who can learn these things quickly, you can still get conviction. So I think it's kind of pulled back to, you just need great technical talent who, you have confidence they can move fast and learn fast. And that's how we think about the technical side. And then, in terms of, to speak to your geography question, I think this geographic gravity has changed. During COVID, there was like this moment of democratization where it's like, hey, you can build a great software business from anywhere, half the team can be distributed. And, I think that's really pulled back to the coasts. And, this hasn't been like a conscious, like we love to partner with founders outside of the coast, but I think the challenge has been, I was talking with another GP about this earlier this week, is like, there's a bit of a mindset difference. And this is not all founders, like there are incredible founders, everywhere that all see the light. But I think if you were to sample your average founder in San Francisco or New York versus, I don't know, I'm not going to pick on any one city, but some other cities, there's just this like understanding that you have to do it differently today. And it has you really take AI native seriously, and it's not just, an afterthought on top of SaaS. And that mindset difference is, I think, very tangible on the coast right now. It'll probably change, but for us, that has led to a larger proportion of New York SF deals than I honestly would have expected.
I mean, granted, I also think that it's one of the reasons, to Brendan's point, why you're getting a lot of these younger founders. I think they just reimagine the way you can run businesses. I'm trying to remember who told me this, but there was a founder who was telling me that like they don't even do outreach or anything like that. It's like the agents go do the outreach, they figure out who to reach out to, and then they just hop on these first calls. And so like, I'm not saying that's like the most scalable thing to do, but it's just like an interesting thought experiment and interesting to see what people are coming up with. And to your point about the technical ability to learn the technical piece of it, Brendan and I were chatting about Peter from OpenClaw. It's not like he's a recent Harvard dropout or anything like that. I mean, he just tinkered, figured out what worked, and ultimately saw what happened with OpenClaw and the rise there. Maybe talking about the market piece of it, now that we've talked about the people piece of it, one thing that I've found particularly interesting about AI, and I'm curious how you tease out the noise, because it used to be the case you could be like, hey, I'll reach out to 10 people and see what their reaction is when I show them a thing, and you'd probably get various degrees of response, and the enthusiasm with which somebody responds to something kind of gave you a signal. Today, it just feels like a lot of these AI products are so magical. Everybody's being pushing to try AI. There's top-down push, bottoms-up push. There's so much demand. How do you tease out what's real signal and ultimately identify which verticals are the right places to go after and build big companies?
Yeah. I think that part of it does for us tie back into the founders. And honestly, this is why, while I completely agree with you around kind of the ability of younger founders often to look at things with a new lens, I also think that if you're looking at founders who are in very nuanced, complex vertical markets, and over the course of like a month, they've figured out what they're going to build in that market, well, maybe then you're selecting for not having that kind of earned insight no one else would see, right? So I think there is something to banking on, like, in speaking with the founder, like prove to me why this is so important in this space and why it has to change, and like why it and why no one else does, right? So I think that's an important aspect for us, is like seeing that the founder has earned that insight. And of course it can come from just like pouring yourself into it. Of course, like some people are just exceptional, or, they stumble upon it. But, I think understanding from that from the founder is really important. And then, I think another thing that we'll look into is, even if you're inception stage, great founders, like they've done a ton of customer discovery, right? And just understanding where that customer discovery has come from, right? Like, did you have some in your Rolodex? Are they cold, right? Like, sometimes the best indicator is just like, hey, maybe we don't have revenue yet, but we've got like 13 design partners, and I just hit them up cold and converted them in a month. And that'll at least tell you that there is urgency around the problem. That doesn't necessarily tell you if, the product roadmap is right or whatever, but and it certainly doesn't tell you, and Vignesh, we talked about this a little bit, but like, what is going to happen in 5 years? Because the reality is there's a lot of use cases right now where there's definitely urgency. It's something like, we're going to return revenue to you by doing AI scheduling or call intake. Obviously, people want that, but like, are there going to be 5 of them? Are there going to be 10 of them that get up to 5 million ARR? So I think defensibility is another area we try to think really deeply about in this era.
Yeah, I mean, I think there's just a lot of questions that ultimately come up. But I think one thing that you've written about is this notion of an authoring layer, and I think it probably comes from picking the right wedge. And so maybe talk to us a little bit about what is that authoring layer, and kind of why do you think that ultimately helps build defensibility, and any lessons or patterns you've seen from the best founders. Like, how do they pick the right wedge in these markets? Because to your point about like scheduling in healthcare, like maybe scheduling is the right wedge to go into a bunch of other post care workflows, and that's how you capture the most value. But just curious, kind of like about the authoring layer, and how did the best founders find that right wedge?
Yeah. So when we think about the authoring layer, we're really talking about, if you were to visualize a customer workflow and look at the various steps of that, we see the authoring layer as really the point where a record is created, right? It's the launch point of a high value customer workflow. And so, in some cases, like let's say in SMB trades, right? That's probably somebody giving you a call, right? The customer calls a plumber because their toilet is broken, right? That is the first point at which the customer touches, the trade. In another market, that could be an email. For another use case, it could be a signed contract, but at the end of the day, it's like the point at which someone would normally, in a past era, say, okay, I'm going to now take this and put it into my CRM. We find it very compelling because if you can be that authoring layer, you can be that point at which those first touches come in, you can create that first step in the workflow. So maybe you automatically add it to the system of record. Maybe you generate that demand letter or invoice automatically. And you can just kind of go down the line and just keep hitting key steps in that workflow. The problem is if you started a later layer, you've probably have systems of record or other solutions that are, upstream of you, right? So this kind of allows you to control the destiny. If you want, it allows you to play nice with downstream systems of record to start and just integrate and not worry about that. So, to give you guys an example, we have a couple companies in the portfolio, as I'm sure you do, that are starting at the authoring layer. One is a business called Tally. Tally is a AI revenue and finance engine for supply chain. They work with a lot of 3PLs. And, for that whole process of like figuring out what do we need to pay, how much do we need to get paid, how much revenue are we leaking, right? Uber complex for a million reasons. But it really starts with, we've got contracts, pricing sheets sitting around in our email. And, you've got a whole team of people, plus usually like millions in BPO spend just focused around that. So if you can fix that of like finding our contract, knowing is the second it hits our inbox, abstracting it, connecting that with like our payment portals, that's kind of that authoring layer, right? We have other simpler, Olympian in our portfolio is focused on, kind of interior home improvement trades. And they did start with that voice AI intake and calling layer. So varies by use case, but we love it for a number of reasons.
Do you have any perspective on defensibility though, starting there? Because obviously, like when you talk about this authoring layer, and again, maybe to use the healthcare example again, or even the services, the trades example you gave, like Service Titan exists as a CRM. Obviously, it would be a very natural enhancement for them to go and add an authoring layer, in your words, that sits on top of their core CRM. So I guess how do the best founders think about articulating, or what have you seen? Like, how do they articulate authoring layer to ultimately extracting value away from the legacy systems of record in a category?
Yeah, I mean, and for what it's worth, like, I'm pretty sure ServiceTitan, maybe it's Procore, but I think that they both have voice like offerings at this point. But I think there's kind of two ways to look at it. One is like your plan over time is to capture more and more of the system of record and become one yourself. And I think if you're going to take that path, you have to have a thesis on why you're going to displace existing ones. And that could revolve around the fact that in your niche, they are shitty, for lack of a better word, and you can replace them. Or maybe it's, well, ServiceTitan is very big, but it also serves a lot of trades. Maybe your thesis is that these are going to fragment and you're going to carve one out. So like, I think you just have to have that thesis around like how you're going to deal with the downstream system of record question. The other angle is, and this is maybe switching more to the tally problem, like there may be systems of record, but they're just not really doing what you're doing. You know what I mean? Like do supply chain companies have document management systems? Sure, they do. But like, there's not really a finance, and sure, they have like QuickBooks or an accounting system, but they don't really have this like holistic financial management system. It's kind of a new system of record, if you will. So, I think there's no one answer. It's just like, are you creating something new? And if you're not, what's your argument for how you're going to compete?
Nick, one elephant in the room, like we think about it every time we're making an investment, 5 or 10 years ago, is like, what is AWS, GCP, Azure going to be doing? Now the question is, when does OpenAI, Anthropic, Gemini, some of these horizontal LLMs get good enough to do, some of these vertical AI use cases? You've argued over the last year or so that some of that lacks defensibility. Like, if you're thinking optimist view of why vertical AI will keep thriving and, some of these horizontal LLM providers won't go down a layer, what's your argument here?
Yeah, I guess my argument is not that there won't be vertical use cases of the kind of horizontal LLM players. It's more so that like the vertical platforms that win and build defensibility will, leverage those and kind of create their own moats. So like, I do think that there are going to be some losers and winners in this whole thing, right? And one area, for example, that we're not really that excited about is folks, of which, there are a lot, that are just trying to be kind of the agentic command center for X, right? I've talked about this a little bit as a solution first approach as opposed to a problem first approach, where you see the AI opportunity, that big industry X is going to adopt it. Let's be the X for Y. But the challenge with that is like you haven't found any surface area for differentiation and defensibility. So I think you've got a lot of these first gen like agentic systems, which are basically just like, hey, we're gonna vacuum stuff out of your SharePoint, and we're gonna give you RAG to search all your stuff, and we're gonna help you create a report. These are the exact things that OpenAI and Anthropic are thriving at, right? Because it's just, that's their core competency. That's not real vertical differentiation. Like if you think about it, at the end of the day, that is a horizontal solution. Now, if maybe your document generation part is more the center and you're more of like an even up and drafting demand letters, there's a lot of nuance to it. Like you start to see how you really need to think more deeply about like, what does this vertical need that's very like holistically different. And I think that's where true defensibility comes from. Because you got to we all know that whether it's Anthropic or OpenAI or Gemini, like they're all going to get better over time. So a question I frequently ask is like to founders is imagine a world 5 years out, like we're on, Claude 14, and it is seamless at ingesting any document you have, asking any question about it, like no issues with integration with any of your like internal systems. What's your, why do you guys live? It's literally a question I like to ask because I think it's a very fair point. We saw what kind of a couple announcements around legal and finance and co-work did to the market a couple of days ago here.
Nic, one other question I had, like you've touched upon this quite a bit. Going back to like, how do you evaluate investments? Everything is a technical product now. Like if you looked at the vertical SaaS wave, a lot of the underlying technologies were sort of abstracted away. And, I even saw you release like a NeurIPS piece. It was like, here's the top 5 things, we noticed from NeurIPS. That is a very deep technical conference that, talking the latest research. How has this wave changed? How do you prepare for that? Having more of a technical lens, as compared to this vertical SaaS layer, how do you kind of like stay fresh as an investor, with that line of thinking?
Yeah. I mean, the NeurIPS thing, I honestly, I'm personally interested in it, but I do think what it's helpful for, even though, I would consider myself barely technical. I'm certainly not an engineer. Like, I think it's important to develop a perspective on like how quickly things are moving at all times. And like, look, I try to read the NeurIPS papers. I understand like, some percentage of it, but I think it does give a taste for like, all right, which of these kind of core problems are going to be broken down in a year and which are going to be more intractable. And like, at the end of the day, maybe that helps inform that question that I ask founders of like how good it's going to be. So I don't know that frankly, it changes that much how we underwrite things. Like obviously I want to be familiar with all the, kind of frameworks that are being used, all the latest open source tools, all the infrastructure. But one thing that's invariable is, as you guys know, when you're backing a team, is 90% of the technical considerations the company will face will be solved by, the technical co-founding member of the team. And if they're not really good, what are you doing? Like if you don't completely trust that person to hand off these decisions, everything's a wash. So we spend a ton of time diligencing those people. And, like any bar that one GP can set on a like technical competency is going to pale in comparison to like years of proof in industry and referencing those people who are like loads more technical and smarter than we are. So that's where we put our chips. But I don't know if there's some GP out there who's like an AI PhD, maybe they do it differently.
I mean, it is interesting that you say that. I do think that you're seeing a lot more technical folks thinking about and evaluating these companies. But it feels like actually one of the arguments that people tend to make, especially when it comes to technical moat, is that, well, there is no technical moat, so speed is the only thing that you have. And I don't know how to. How do you think about underwriting speed as a moat? Like, is that the thing? Like, if you just run fast enough, do like the technical or lack of technical defensibility, does it just go away? Like, how do you think about that?
Yeah, I mean, you guys might have seen that moats piece that we did, and like, I think like we made the like fair, maybe controversial statement that speed is not a moat, and that doesn't. I think what we were trying to imply by that is that it's not like, it doesn't really fit in the category of moats. Like, obviously speed is very important, but like, is magnetism a moat? Is like awareness a moat? Is like exceptionalism a moat? That's like it's like an inherent quality of a team where no one would ever, like, more is better. You know what I mean? Of course speed is better. Like, sure, you don't want to be running full speed into a wall. You have to have vision too. But like, I think everyone, founders and VC included, like, holding the quality bar steady, speed is paramount, but it's not inherently a moat. That's the one thing I just don't get about people claiming that, is like, okay, so speed is a moat. So like, how are you going to be faster than other like top, 1% founders? Like, so I don't know. I mean, I guess maybe to put more pointed answer to the question, I think there's there's more value to speed these days, in the sense that, like, as we were talking about before, there are some great AI wedges that are clearly working, but also probably clearly indefensible. And so I think it's still a bet, because this is also new, but like, I would rather be like, I mean, if you're not like first 5 to the market, that's tough. I don't think you have to be first to the market. I've never believed that, but like, if you're 12th to the market, that's not good either. So I do think there's some value of like getting to some scale, because, you earn the right to build more. But I don't think it's a moat personally. Like, you need to use speed to find defensibility and earn the right to build things that are, durable. That's how I'd put it.
I mean, I think it's a good point, because interestingly enough, I was talking to somebody else about this as well. And I think one comment was that in AI, not only do you have to be fast, but you also have to build your second product faster. And so to your point, the speed piece of it is only helpful insofar as you have like a product 2, 3, 4 that you know that you're going to release, and you release them really quickly in succession, so that you try to capture more and more of that workflow and that workspace. And obviously in AI, and I think maybe a question for you, but one of the things that's interesting about vertical AI is the fact that it does feel like the markets are opening up from a size perspective. Like, there are just new budgets to go after. There's more demand. I'm curious, like, as you've now studied the space, and again, I know it's early, but like, what are you hearing from customers? Like, everybody talks about vertical AI opening up TAM, but is that a real thing? Like, are you seeing that actually happen?
Definitely seeing it happen. I guess how I'd qualify it is, right now we're in this really unique era where pricing is being reconsidered wholesale. And when I say pricing, I mean like how do startups charge? Monetization, right? And right now a lot of these wedge products are getting in the door fairly easily, because the calculus, let's go back to the SMB trades example, right? Like, you can hire 2 or 3 more people to sit in your front office and answer phone calls, or maybe hire a BPO if you're bigger, or you can buy this thing. And that kind of labor arbitrage, if you will, is like, it's very clear and discrete. And then plus they see revenue coming back. I don't think though that labor kind of anchoring is really how things are going to be looked at long term, because especially with these wedges that we're talking about, like, they're going to get commoditized. Like anything else that gets commoditized, the price will be competed down to the marginal cost to deliver it. And so
in 5 years, you don't compare agents to humans, you compare agents to other agents, right?
Exactly. Like, I don't compare the cost of buying a car to the cost of buying like a team of thoroughbred horses. And, like, it doesn't make any sense. Like, if I can do something for cheaper now, that means that the salary I paid someone to do it is irrelevant, is now irrelevant. So I think there's like this unique moment in time where what customers are using to compare prices may not be the long term, but I do think what we are also seeing is like, it's very clear that this connectivity between like IT budget and what you can capture as a startup is exploding. And that's a good thing, because if you look at this penumbra of additional spend that includes, maybe it includes labor, but honestly, I look at services. It's multiples of what is spent on software today. And that, I think, is where like there's an enormous opportunity for companies that can just keep earning the right to build more.
Do you think the services piece, like, I guess from just what the companies you talk to, because obviously we hear this services software, we've been talking about it a lot internally, but I'm curious from with the companies that you work with, is there a downside to this whole services replacement thing that we've not seen yet? Meaning, like today, it feels like most companies basically just throw FDEs at the problem, and I get it, because I think it's actually economical to throw an FDE at a problem when customers are paying you so much. But if you have this, deflationary pressure coming from commoditization, over time, does it lead to sort of I guess a services trap where you're throwing people at problems? Like, I'm just curious with your companies, how are you kind of guiding them through that? And maybe you don't think about it because the unit economics work today.
No, I do. I mean, I guess the distinction I would make is there are services in the sense that your customer views them as services, and there are services in the sense that they're being provided by humans employed by your startup. The former is interesting. The latter is like a maybe, right? Because I think the most compelling vision of how vertical AI expands the opportunity into services budgets is that previously there were things that humans had to do. So they were either, you got a consultant, you got a BPO, whatever it was, right? Now, with the help of AI, that can be provided in a more, if not fully automated way. And so in a way, your kind of software is subsuming services budgets, right? And I think that is what's really interesting. I think on the you're providing service, you're actually hiring humans. I mean, I think it can be worthwhile for a couple of reasons. I mean, sometimes you may have, it may be core to your startup's hypothesis that you are going to automate that. And I think if it's reasonable to believe you could, and it's not just like a pie in the sky, like, hey, we're going to, there's like that historical thing with AI where founders would be like, well, it's 0% today, but next year it's going to be 7 and then 80. It's like, okay. But if it's like, hey, we're early and we haven't fully built it out yet and we need some human support around it, or like, in order to optimize the product, we want to have some like human in the loop reinforcement learning, or for implementation, right? It's a big enterprise contract and like they don't get how to implement AI yet. We're going to help them. I could see all those arguments. I think what's dangerous is like just making the assumption you can fully automate something. I think that's where I've seen startups fall into the services trap.
Well, I think to me, the question is, it feels like for most companies, they do it to implement AI and especially handle edge cases. And I think the challenge is like the edge cases can be, very, very large. I mean, AI is really good at I guess what I call the first mile, or call it the first 80%. It's like the last 20%. And if you don't get the last 20% right, I think customers churn and get upset. And so this is why I've been thinking about this a lot. It's like the FD model works, and I get it when people can pay a lot of money. But tomorrow, if you're expected to handle, end-to-end tasks and automate workflows and all that good stuff, but you also don't have the pricing power, then the economics around this stuff change. But I mean, again, it's all still so early that we don't know the answer, but something I've been thinking about.
No, I think it's a really important one. I kind of have this mental framework that I think about. Wrote a bit about this last week, I think, of being internal versus external. So, if you are a business that is providing a service with, kind of human headcount, and you're just viewed by the customer as another vendor that can be swapped in and out, right? Like, hey, we give you this and we deliver you a report sort of thing. That's challenging because even if it works really well, if someone else comes along to do it tomorrow for a cheaper price, why not swap? Switching costs are low. And because you're not inside the organization, you're not getting access to first party data, to know how to like see how they work. You're not really earning the right to build peripheral products. I think much more exciting is let's say you have some implementation services, but you're helping implement a product that's being used internally or inside the organization. Like that's much more compelling to me than, these businesses that say like, oh, software is dead. We're just going to be the service provider. I mean, it's worked for a few, but I don't know. Less exciting to me.
Nic, let's segue to vertical AI is a big category. You're pretty thematic, you and Omar, and how you look for new investments. What's piquing your interest right now? Like, what are some of the sectors, subsectors you're most excited about? Where are you hunting for this next wave of Euclid portfolio companies?
Yeah, well, I'll caveat by saying, we're very much open to any market, to any sector. Omar and I have respectively been investing across the economy in vertical software our entire careers, and I think the same extends to Euclid. Part and parcel to our stage, right? We want to be open to great markets that maybe even we didn't think about, that the best founders bring, to us. But, to kind of give you a sense, obviously we do run internal roadmaps and we do have interests that change month to month. I think we're not dissimilar from probably the rest of the venture world in that we've been very excited about a lot of the opportunity in healthcare lately. Recently we have made investments in I'd say in the last year, kind of three different businesses in the healthcare space. One in EMS, emergency medical services. One in dental. We in the past we've had investments in behavioral health and rehab. So it's just like healthcare is obviously a third of the economy, and it's no surprise that it's nearly a third of our portfolio as well. We also have been increasingly interested in retail lately. Supply chain is another area where we feel like has somewhat been in the doldrums over the last 2-3 years, but we're starting to see some mature ideas pop up there. So changes every month, but those are a few.
One maybe just to think about kind of the opportunity set and how do you kind of spend time, and just to give founders a little bit of perspective on kind of how the decision making process happens. I mean, look, obviously you talked about a whole bunch of different interesting ideas, but when you go and are looking at a deal, obviously I think one of the things that's not obvious to people that are not in the venture industry, it's never a deal on its own, right? It's always a competitive set of the other things you're looking at the time, and you're fighting for attention. Like, if you talk about the areas that you're excited about, maybe just give some color on why those areas are exciting. How do founders kind of think about, or how should founders think about positioning their company, their approach to drive the most interest and drive the most demand from someone like you?
Big question, man. Really saddled me with a big one. No, I mean, I think like, my advice to founders would certainly be like, do your best to pre-qualify fit. I think hopefully with us, we make thesis pretty easy, right? Like, there are gray areas, but I think most people can glean what vertical AI is. But also stage, right? I mean, I think that is a somewhat muddled area these days. Is like, I mean, what you guys tell me, what does seed even mean anymore? It's everything from $15 million rounds to $2 million rounds. Like, the way I think about it, Euclid, at least as we're investing today, is you probably haven't raised more than $1 million or so. most of the time you probably haven't raised anything. You probably are within, like, if you've started commercialization, you probably within like a month or 2 or 3. You're most likely within a year, if not 6 months of formation. So like, these are kind of just internally how I think, like my quick hits on like, okay, is this going to be relevant for us? And, so I would just like, to the extent you can, and I know as a founder, VCs aren't always the best at like publishing these things openly, but like, doing your best as you ask around and you get intros to be like, what do these people actually like? Should I be hitting Nic up for like an $8 million seed? Probably not, and then, I'd say like, having like materials that lay out what you're doing clearly is always super helpful. I personally, I really like the memo, especially for a super early stage founder, like creating a deck can sometimes be a whole thing. Like sometimes I find the memo, the 5-6 page memo, whatever it is, like, is it hopefully a helpful exercise for you and like maybe a more narrative way for us to glean it. And then, like honestly, the call, it's, first call you have with venture investors, like it's like anything else in life. Like you're judging me on that first call. I'm judging you. We're trying to figure out like, do we vibe? Is it a good fit? And like, I don't know what I can say along that. It's just, try to demonstrate, why you need to exist, like why you're the person to do it. And I guess that's somewhat of the art of our job still, is sussing that out.
Well, I know Brendan and I definitely wanted to talk about this notion of consensus investing, and I think we'll come back to that in a second. But maybe just double click on healthcare. I think since you and I both spend a lot of time in healthcare, any particular areas where you're excited about? One of the questions I have a lot about healthcare is, obviously you have these just big hulking incumbents, and look, we all know Epic isn't the greatest when it comes to software, but they also have a pretty good stranglehold in terms of what people buy. And then on the flip side, I've never seen such an explosion of health tech companies. Even in 2020, 2021, like this just dwarfs that. And all these companies kind of feel real. There's just so many like scheduling tools and prior auth tools. And so how do you kind of make sense of that noise?
Yeah. I think at the end of the day, it can be challenging. You mentioned prior auth, right? Like clearly a huge problem. It's got to be solved. But I think there's a bit of a psychological element for VCs, or at least I can say there's me, where it's like when I've heard about 20 pitches around something, I just start to think like, I don't know, am I late to this? Like I've seen too many credible ones, and like I try not to lean into that too hard, because the reality is like, I don't believe you have to be first to market to be, the market winner, or at least one of them. But I just really try to understand and suss out like, what are you doing differently? The one benefit to having a market where there's more noise and more examples is like, it's easy, and every VC is going to ask you like, why are you different? If you are, and if your argument is like, honestly, it's just, this is the right idea and there's like 2 other good teams doing it, just say it. Like, just get it over with. But the one thing I can't deal with is like founders who are in a noisy market like that, don't understand what the other players are doing or haven't heard of them, and can't articulate why they're different and why that matters. Like that's something you should probably know, right? Like, because people are going to ask you anyway. It's the easiest VC heuristic, right? Like, of if we saw Sierra, my friends at Sierra did this great looking deal, like tell me why you're different. It's just a nice mental thing. But honestly, like if I'm being honest, the stuff that most gets me excited is when someone is taking a fundamentally different approach, or it's a space or an approach I haven't heard of. And often it's like you're operating in a known category, but you're taking a different approach, or you're targeting a different segment, right? So to answer your question, I don't think I'm alone in being really excited about the opportunity for AI to impact RCM. huge space, revenue tied, like deals with numbers, very acquisitive, right? Like just, I don't know, lots of sexy stuff about that market. And it's something that just inherently AI should be able to do a great job at. But it's got all sorts of nuances, like tons of stakeholders. You got, payers, clearinghouses, consultants, like just tons of surface area there. But like it's very different for behavioral health, which is very different for dental, which is very different for big health systems. And so, there's room for multiple winners. And by the way, the public markets, bear that out too. There's multiple public RCM companies. So that's an example of a space where it's like the larger space excites me, but then what really gets me excited is when someone says like, I have this unique approach to it and or in this unique space.
Nic, great segue. So you've written a little bit about, how we're kind of in this consensus era of investing. And it seems like this is actually kind of the winning strategy. Like 41% of all dollars have gone into like 10 companies. But traditionally, like you should be zigging while others are zagging. Where do you find alpha? You just talked about, hey, I just found something that I've never seen before, or this is a very binary, sort of outcome that has a lot of potential. Is there still alpha left for some of the early stage contrarian investing? Is that asset class broken? How do you kind of think about this?
Did you really just ask me if I thought there was alpha left in early stage venture? Is that the question you just asked me? Yes, there is.
Contrarian. Only in contrarian bets.
That's fair. Yeah. That's fair.
Or should we be just signing up for every $100 million round? Party on VC, right? So,
I think that, like we've written a ton about this. Obviously, we have a certain point of view, which is that like any other industry, venture goes in cycles. We're in one of capital consolidation. Overall capital in the asset class continues to grow, I think in line with the incredible growth and opportunity that exists. And meanwhile, the increasing share of the economy that technology accounts for. But within that total bubble, more of the dollars have been going into fewer and fewer hands. And I think like inherently that has the knock-on effect of driving consensus. Like the part of the benefit of having a thriving and somewhat fragmented venture ecosystem is you have lots of players that are competing for edge, that are taking different approaches, right? It's like classic, capitalist competition. And that's very healthy. We should have that. Like our industry would not operate how it is and would not drive alpha if all of the dollars in the venture asset class were given to one firm, right? It just doesn't work. It's like saying that all software companies should be one company and that's going to be better. We know that is just facially untrue, right? We need competition, new ideas. So, and look, in the wake of any market contraction, if you just look at the numbers historically in private equity, I think in asset allocation overall, like there is a flight to safety and typically a retrenchment towards established brands and some consolidation. So that's natural. But I think we've gotten to a place in venture where like some of the things that are happening are just don't really make a whole lot of sense, right? It's like, why are you going to invest in venture when in reality, like the strategy of putting a $50 billion fund to work is just, it's not going to generate traditional venture returns. So I think that what I would imagine we will see is, allocators recognizing that is the case, that, hey, we have later stage funds that are much bigger. And, by the way, they may return great returns for their, AUM, and that may be diversified versus S&P 500. But that traditional bucket of like, true alpha and like outlier returns, we're going to have to look elsewhere for that. And so that means we're going to have to figure out how to deal with this new normal of more funds and underwriting that type of fund. I think that'll be good for the ecosystem. It'll be good for contrarian investing, which I think is always proven to be the driver of alpha in our industry. And, I do think we're a little detached from that right now, but, I think it'll come back.
So I guess the question around contrarian bet taking and making investments in these types of companies, I guess the question that we've thought a lot about is downstream fundraising in markets, and we're seeing this in every market, whether it's healthcare and in different subsegments, ERP, what have you. Like there's just this whole notion of king making, and I think it makes this idea of taking contrarian bets hard because the availability of capital for these sorts of bets downstream becomes a little bit more challenging. And so how do you balance, I guess, picking stuff that's, I guess, mainstream enough while making sure you can find like these interesting opportunities, but having the capital downstream to actually fund these businesses?
I guess what I would say to that is, downstream investors have the benefit of choosing the best companies that are available to them at the time that they invest. And so not everyone thinks this way, and that's good. But if I don't make decisions based on what downstream investors want, I don't care, because that's not my job. Like, I want to learn from smart people, of course. So people who are like road mapping in my space and like sharing thoughts. But if I'm in the way I think Omar and I would think about it is, if we are making decisions based on what, like, let's say a growth investor wants today, we are selecting against those disruptive things that will be, will be a thing in a couple years, right? Like, we want the new ideas, not necessarily the like reaction to the current market. And I do think, like, we talked a little bit about this as scale inception, I think, is kind of like a term we used, because like in a world where you get these downstream funds that have a shitload of capital, and they was like, oh, we raised $5 billion last time, now we're raising $10 billion. Sure, one, you can go out and hire more people to allocate those dollars, but inherently you also are going to write bigger checks, and you're going to look for more and more supply. And I think as a result, we've seen like them launch accelerator programs. You've seen like YC et al. Scale up and do more bigger cohorts. And it's all this like, call for startups. And it just all seems like so ass backwards to me. It's like, that's, like if we could run venture like a command economy and have it generate the returns it could, we would, and someone would be monopolizing it. But that doesn't work. To be like, here's like, this is the idea for the next OpenAI. Like, where's the founder that's going to do it? I mean, I don't know, man. So I hear you. And like, inherently, of course, like every VC has got that, like, I mean, I think actually you may have mentioned this to me or something. Like, you do have to think about like, who's going to do this next? You have to think about it. I mean, you'd be silly not to. But I don't know. Maybe I'm crazy, but like, I feel like you've got to develop your own conviction in being able to build a big business and, take it from there.
And by the way, everything that we've just said, funny enough, the one granddaddy of all of this, OpenAI, was almost an accidental win. I mean, they were a research lab for very, very long until this breakthrough showed up. I mean, if you had asked somebody to invest in OpenAI in 2019, they probably would have laughed you out of the room. So I think all this said, there are some very big contrarian winds that are staring us right in the face.
I think that's true. I think there's this, you guys tell me what you think, but there's this like retrospective consensus manufacturing that goes on in our world where like once a company is clearly a winner, people are like, oh yeah, I mean, I love that space. It's amazing. Look at this company. And it's like, dude, ask that founder what it was like in the seed. And he's like, could not raise, or like wandered in the forest for 3 years or whatever. Like, and it seems that way now because there's been a winner. And so that's what, like, we say that all the time in vertical. It's like, no one gave a shit about like platforms for plumbers, and then ServiceTitan got everyone all hot on trades. So like,
yeah, it's an interesting chart to look at. Like every era, the big winners, that was not the hot trend at the time, usually ever. I forget who had posted it, but and glad to hear we confirm there's still alpha and early stage investing. We can all keep our jobs and maybe sleep at night going forward. But hey, I want to also just kind of give this an opportunity, for some of the pre-seed founders that might be listening to this. Like, what are the common mistakes you see within the first 12 months of launching the company? And I know you talked about it's, some of it while they're raising, but what are some of the gotchas that you see, working with founders here the last 15 years?
Yeah, I mean, I'd say that, one is like early on in your idea phase when you're mapping this out, there's never enough customer discovery. And I'm not saying take a year or whatever, but you want to talk to 50, 100 customers in your space. And especially as your idea iterates. And often it's those people you get kind of ideas from, or you just run an idea by, that later you'll come back to and try to get as design partners, right? So I don't know. And you got to balance this with moving fast and hey, when a founder gets conviction, they get conviction. But I feel like there's just not enough talking to customers that you can do. Which ties into my second point, which is I've always felt like the best founders tend to sell well ahead of product. And this is admittedly maybe a bit easier for transactionally priced or SMB price solutions than enterprise. But if your customer is feeling a pain point so urgently, they will often be willing to sign up to something, a design partnership, or maybe even pay for it, recognizing that the product isn't there yet. And that urge to go out and just sell it, there's I don't know, I would bet there's a connectivity between that predilection amongst founders and success, that desire to get commercial validation. So I'd say those are certainly two things. I mean, another is just bringing on the wrong first or second hire. Often these days I see a founding engineer being the first hire, and you got to recognize that person, of course, is going to be helping to build your product. That ties directly into our velocity point, but it also really does set the culture. And, who you can hire is 2 and 3. Well, in a lot of ways, bank on who you hire in number 1. And so I think it's that's one area, honestly, where as much as I hate this, it's worth taking time, and it's worth saying no to those marginal folks that you don't have the gut checkbox on, because it's just so important. I mean, those are a few that come to mind. I mean, look, I'd say maybe I'll just give one more. Don't just, this is a well-worn venturism, but don't raise just to raise, look, if you're a high-profile founder and you can get whatever money at whatever price, I kind of don't blame you. But every raise is, if you're doing well and things go well, every single raise is going to be the lowest valuation you ever raise at again. And remember also that sometimes if you have too much capital, that capital helps obscure problems you otherwise would have had to face head on by throwing bodies at it, by hiring consultants for it. Inevitably, you'll waste 10% of that extra money that you have, but the much worse opportunity cost is that you aren't forced to be as agile and to work out all the kinks in a way you would, if you raised the right amount. So yeah, I don't know. How do you guys feel about that when you're looking at a pre-seed seed coming into a round you're going to lead? How do you think about how much capital they've raised as a barometer?
Um, I mean, look, there's uh, I guess call it a tactical element of this of just like, hey, is this deal going to be a fit for Sierra? And so like that's one thing we have to consider, which is like if they've raised a lot of money at a very high price, oftentimes it's just like, well, I get it, but even if it's an interesting company that we would fund, it may not be a fit. And interestingly enough, I think there are probably going to be a lot of companies that have just raised a little too much money, won't have gotten that like crazy 1 to 10 or whatever that makes it an obvious investment for somebody downstream, which I think kind of hampers fundraising ability for some founders. So like that's the tactical piece of it. I think the flip side of it is obviously if you see a company that's like, hey, we got 2 people, look at how fast we're growing, look at how fast we're scaling, like clearly something's working, and so it just like behooves you to take a second look and take a deeper dive into what's going on. And by the way, this kind of ties back to the earlier point I made around like FDEs. Like if you don't have the resources to go be able to hire FDEs and just throw bodies at problems, like I think you end up having to solve more difficult problems that ultimately end up getting you to some next level of scale. And I think with a lot of great founders. I mean, I was talking to the I think it was the Pylon founder. They iterated through like 5, 6 different, like they iterated through a bunch of ideas just because they didn't have the money early on to make it work. Like they knew what they wanted to do, but they just didn't have the money early on to go and like try a bunch of these things. And so I think it forced them to just be ruthless about like what they actually went and built. And ultimately, when they went and built it, you just like felt like they got shot out of a cannon with that first product. So I think you're right, and there's another element of this which forget the Sierra lens on it, but I think you've also written about this, which is I always talk to founders about optionality. Like at the seed Series A, like one of the things you want to make sure is that look, if an opportunity shows up tomorrow and somebody says, hey, I'm going to acquire the company for $200 million, like what's the response that you get from the board and around you? Like obviously. For a lot of us, if we're excited about the deal, we're going to push and say like, hey, I think we could go bigger. I think we could go farther. But a lot of times this is life-changing money for people. And do you really want the pressure of somebody that's like, well, it's not a big enough return for my fund, so I don't think you should take it. I don't think that seems fair. And so I think alignment matters a lot. And I know you've talked about this as well, Nic. I'm curious, what do you think about this whole notion of kind of creating alignment at the earliest stages from a investor perspective?
Yeah, I mean, we wrote a piece on this called "The Quiet Death of Founder VC Alignment." So maybe you can glean from that, like obviously, whatever your titles have to be a little controversial, but I mean, I think the entire line of thinking for us there was, we've seen fund sizes grow. In a lot of cases now, you have funds that. Seed fund that's $500 million or whatever. Now, if you just think about, and I'm speaking to VC or founders rather, because GPs all know this, but like, obviously we have to generate returns for our LPs. There's a certain threshold that is, considered good. That's expected of our category. And, if you're 500 million, you got to at least bring back, I don't know what people are targeting, right? But like, a couple turns on that minimum, right? And so that means that your average founder needs to achieve a certain level of exit. And so there are going to be barriers for a big fund that a smaller fund's not necessarily going to have. So as a founder, you just got to think of like, how can that affect you downstream? Do you want somebody on your cap table early that literally cannot care about you unless you're a $5 billion plus exit? Do you want to be in a situation where you have an offer to be acquired after your Series A for $500 million and the VC is like, no, I don't want to do this. And they have control. Like, and I'm not saying this happens all the time. Like, I'm not trying to be an alarmist, but like, it's worth thinking about, I think, how like your venture capital partner, the person you decide to bring on your cap table, like is aligned with you or not. And, different strokes, but it's certainly a thing in a world where we're seeing like big early stage funds, like stuff we didn't see 10 years ago.
And by the way, it's hard enough to build a company. Like you just don't want to add any more unnecessary roadblocks to yourself, right? To like create a great outcome. And that I think is really what it's all about. I think your point about enough time spent by whoever the partner is and whoever the firm is, I think that's really the important takeaway, right? It's like if the interests and the incentives are aligned well, like everybody has the interest and the willingness to put in the work. And we all know it just takes a lot of work, especially with how early some of these companies are, and especially with how crazy the AI world is. It's just going to take effort and time. So I'm totally there with you.
Vignesh, I think like one quick point on this too is like on round size. One of the more interesting questions you've been asking in some of the pitch meetings that we've had is like why 5 versus 10, or why 10 versus 15. It's really interesting to see how a founder reacts to that, because I don't know how often they actually get that question, because a lot of it's just like, well, we kind of can raise this, rather than like you kind of think about how they're going to build the business from the ground up. Say, hey, we need 10 because we need these 3 hires. We need to get to this revenue threshold to kind of make this work. We need to unlock this product. So I think it speaks to the methodical nature of that founder. The other way that we say it at Sierra is like not creating stretch marks along the way. So, raising into trying to find kind of that Goldilocks, amount, whether it's the seed to A or A to B, that allows you to build a sustainable, fast-growing company, but sustainably fast-growing company from the ground up. So just a couple quick points back to your question a little bit earlier, Nic.
Yeah, good points for sure.
All right. Well, I think we're running close to time, but it wouldn't be a VC podcast in Q1 of 2026 if we didn't ask you about SaaS apocalypse and the death of SaaS and your thoughts on that. So I'm curious of what your reaction has been, A, to like what's happened in the public markets, but B, how it's impacted PE portfolios, how it's impacted like legacy companies in different portfolios. Like what's your take on the death of SaaS?
Yeah, man, it's really amazing how much market cap SaaS has for as many times its death has been foretold. I don't know. I view this whole public market down thing as like kind of silly in a way. Like I look back at it, I'm like, so it was triggered by like Claude releasing co-work, and that's what triggered like a 30% drawdown. I always think there's like way more factors going into these public market swings than, like a journalist always wants to tie it to like one thing that happened. I think there's so many reasons disconnected from AI that this could be the case, that like, you have certain companies that just announced that are underperforming. You've got maybe some views the space is overvalued, sector rotation, but high level, the whole SaaS apocalypse thing, I would say 2 things to it. One, I think people are conflating like the subscription monetization model with the fundamental business model of software as a service. AI is SaaS. AI is software. These are all the same thing. Azure, GCP, AWS all still make tons of money. So, at the end of the day, like as a fundamental model, it's not going away, even with AI. And, I think like there's a difference between the fundamental business model dying and a new generation of winners emerging. And I think the latter is really what we're looking at. Now, of course, if you think that, I think in one way you could look at this as like a validation of the reality of AI as a economically impactful phenomenon, because people are pricing in that there's maybe a little less out-year terminal value in some of these like legacy SaaS solutions because we're going to see new emergence. So I think in that sense, maybe it makes sense, but I think anyone who's like saying SaaS is dead is just drastically oversimplifying what's going on. But
which, by the way, I mean, I think there is some truth to it, which is to say that I think there are some SaaS companies that were formed very early on in the SaaS world, and I think are just in a poor position to be able to really navigate the AI waters. But like the flip side is also true. I think there are some really interesting SaaS companies that will find a way to embed AI and turn into really great companies of tomorrow, and will navigate the waters. And I think the same is true for AI companies. Like AI companies that do well today may get overtaken by incumbents that find a way to add AI into their products. It just like it just a new generation of software, and that's why even like the word, like I always kind of chuckle about like, hey, we invest in AI companies. Like, you don't say you invest in cloud companies anymore. Why? Because you're supposed to be using the cloud, right? It's like the same thing. You're supposed to be using AI. Everything is supposed to be AI. It is just software at the end of the day.
Totally.
Yeah.
And like I think that the what I disagree with is this concept that like SaaS is dead, because it just doesn't really make sense to me. But what I don't disagree with is, I think if I hear a lot of people saying, well, but like incumbents have the like better positioning in order to launch AI companies. But if your judge of like preparedness to win on a new technology was access to existing customers, no new players would ever win. Right? Like I have long term, there's some big companies I like over others, but like I do not believe that much of the innovation is going to come from big companies at the end of the day.
Yeah. They have it's the classic innovator's dilemma that everybody has. But it's still just so early and so frothy. I think it's easy to make narratives that move markets in wildly in one direction or the other right now. So
apparently, yeah.
Well, Nic, appreciate you jumping on for and being the first guest ever on the DPI podcast. Thank you again to all our listeners for joining us.
Thanks for having me, guys. Ton of fun.
Thanks, Nic.
Thanks.
Cheers.
Cheers.